Joining me now is Jason Horn from Steyn Capital Management to share his analysis on the day's market's performance. Jason, thanks so much for your time this afternoon. So earnings season, right, still ongoing. And I want us to zoom in on iPhone maker Foxconn's numbers, topping estimates and delivering a 27% increase in operating profit. That AI server business also seems to be performing quite well. Is this one you follow? And what are your thoughts around Foxconn as an AI player, bet on the whole AI boom?
Yeah, thank you for having me. It seems like another day, another AI-induced beat. So I think from Foxconn's perspective, it's actually quite interesting to see diving into the numbers, looking at what has driven the beat, and obviously it's the AI side of things. So where AI servers reside in their business and their cloud computing business, this is the first time ever that it has actually overtaken effectively the iPhone sales portion of their results. And it goes to show that there is no slowdown in this big AI build out. And from an infrastructure side of things, it's definitely an interesting one. And guidance as well is also really bullish. Overall a very, very impressive set of results.
And it's either you jump on the bus or get left behind. And sometimes I get worried about Apple. I know I'm diverting here, but I sometimes get worried about Apple and its strategy when it comes to AI. Because looking at those US tech players and how they're integrating the AI tools and how Apple is not necessarily at the level where your Meta, your Amazons and your Microsofts are. Are you not concerned about their approach or the lack of strategy when it comes to AI?
Look, I think from Apple's perspective, it's been well documented what a disaster Siri has been and trying to combine AI with Siri. I think it's in less than a month where they do have their big fall event where things should become a lot clearer in terms of what they are going to do. Are we going to be looking at acquisitions? Are they going to be binning Siri? It will become a lot clearer within the next month. But yes, I mean, given the nature of the AI sector and how quickly things are moving, it certainly is a worry that they could be left behind.
Yeah, and talking about acquisitions, something I and many have found quite shocking, quite perplexing, is that Perplexity making a bid for Google Chrome. This, of course, comes as Alphabet faces pressure to divest from its search engine. Interestingly, the bid worth $34.5 billion, but Perplexity valued at around $18 billion. Hey man, the math is not mathing here, Jason.
No, that's true. I guess from Google's perspective, when you're dealing with antitrust and competition commissions, effectively one way to get around it is to say, well, if these different parts of the business are broken off, they will cease to exist. So it does look like a bit opportunistic from Perplexity's side, but at the same time, I think from their point of view, if you look at Google Chrome's kind of market share, looking at 70% of desktop browser market share, which are about 3.5 billion users of Chrome. So if they were able to manage to cobble together the $34 billion and they could actually convert those users to pay $20 a month, you can actually see why they're doing that. But I wouldn't put this high up there on the likelihood of actually going through.
Yeah, I mean, some analysts, when I was reading through the articles about this, some analysts were like, nah, this is just a publicity stunt, considering that Perplexity has also launched its own search engine.
Absolutely, they're still in the early stages, rolling that out to only a few users, but if they could get this acquisition over the line, it would provide them instant scale whereby people would actually be using Perplexity AI versus a quick Google search, with it being fully integrated into the Chrome web browser.
All right, let's bring it back home. In the banking sector, Standard Bank delivering positive numbers, HEPS up 10%. The CIB unit, really the star performer there, contributing more than 50% to overall earnings. On the downside, though, PPB, that is posting flat earnings and BCB posting a decline in profits. So overall, a good set of numbers. But when you zoom in, you start seeing those pressure points, right?
No, absolutely. I think just first of all, it's a fantastic beat, and it's a set of numbers that the market clearly likes. I mean, to be fair, numbers were pretty well guided by management, but at the same time, yeah, strong ROE at 19%, which is quite important. And I think if we talk about all the macro issues surrounding South Africa, consumer being under pressure, the fact that they are reiterating guidance as well is super important. And yeah, one has to admit that Standard Bank is delivering continuously, and it offers the growth that people seem to seek on the African continent too. And we have an African team here at Steyn Capital who throughout the year are in contact with these local subsidiaries. And based on our engagement, it is reflective of that growth story in Africa.
All right, and then in the mining sector, all that glitters is gold. And, DRD Gold being a beneficiary of the higher gold price, expecting profits to jump by as much as 74%. Now, this comes as no surprise.
Absolutely. I mean, when you have a 31% increase in the product that you are taking out of the ground and selling, it's bound to have a meaningful impact. But I think, look, results are pretty good. It is ahead of what Bloomberg consensus is by about 8% if we look at the midpoint. But having said that, maybe a little bit light in terms of the amount of ounces they managed to pull out the ground, and operating costs slightly higher as well per ounce. But overall, should be, I mean, on a relative basis, the gold miners are under pressure, but should have a relatively good day.
And now from a group that expects a profit bump to one that's warning of lower earnings, Truworths saying price cuts have weighed on its performance, and this despite a good showing from its UK stores. Markets punishing the group. I think the last time I checked the share price, it was down close to 10%. It's not really faring well.
No, not at all, and a horror set of numbers, to tell you the truth, and really getting punished. I think something to think about is the actual weakness there in the second half of the year. I mean, they're guiding for about 4.5% lower on a diluted HEPS basis, which probably means that the second half is about 17% lower if we look at the midpoint. So coming under a lot of pressure. Africa really disappointing as well, negative. But just goes to show that in South Africa, discretionary retail is a very tough place to be right now.
Yeah, I mean, even if you look at the likes of TFG, the likes of Mr. Price, those updates also didn't necessarily do well, with markets punishing the groups as well. And I guess also just evidence that the consumer is under, some pressure.
100%, and almost feel like a broken record here with where South African interest rates are at the moment. The consumer is on their knees, and the reality is, we need further rate cuts, and the SARB has been very hesitant to do so, continuing in the media to anchor around the 3% level. But hopefully as things look like they are moving on the rate cut front in the US, we'll probably see some follow through, giving the SARB a bit of room as well. I mean, if we also just look at what's happening with the rand so far this month, as well as oil prices coming off a bit as well, probably feeds through into probably a lower petrol price for next month. And the SARB takes this all into account, which would probably be net positive from an inflation perspective. So, I'm of the view we should have more than just one or two cuts, but it is certainly needed for the consumer in South Africa.
All right, let's hit pause on the conversation. Before we move on to your stock pick, let's take a moment to touch on what counters your industry peers are watching closely.
I'm going for a string of rate cuts in the US. They're going to happen. And an area that has lagged has been on the home building side, on the housing side. And I think Home Depot, still a superb business, long, strong history, well managed, good balance sheet. I think it's time to start looking at companies like that. So I like Home Depot. I still have it in portfolios, but I think I wouldn't be, I'm not afraid to start increasing or look at it as well. But I think we're going to go into that kind of area now, which is going to throw open a whole lot of new opportunities.
Little Basil, that's from, with my Afrikaans accent. But it's not a small company. I think it's the second biggest, basically chemical company in Texas. They've got a JV previously with Sasol, so that's the name Little Basil should ring a bell. And just look at the share price; it's dropped to below the recent April lows. It's sitting just above the 2020 COVID lows.
Yeah.
It's a chemical company, not too much dissimilar from what Sasol is doing in Louisiana, with their chemical business, and it's plastics at the end of the day. And no, the chemical market isn't a downturn; it's a cyclical business. You try to buy these when the P's are high. Now the P is high after the latest set of quarterly statements, and I do not suspect the next 2 or 3 quarterly statements to be great either. But they are one of the lowest cost producers. They're in the top quartile of low cost producers. They will sit this one out. They've got a very strong balance sheet, and it's trading at an 11% dividend yield at this moment. Even if they do cut a dividend yield, which they can hold on to, you'll still sit with a 5%, 6% dividend yield. So if you're willing to ride the downturn in chemicals out, this is the way to do it. This is like buying Sasol at 50 Rand.
So international counters, Lyondell Basel and Home Depot up for analysis. Do you like those companies?
Yeah, look, I mean, on the Home Depot front, I absolutely buy the argument that lower rates will benefit the likes of Home Depot. It's so closely linked to home builders in the US. Mm-hmm. Based on the share price, looks like a lot of that is priced in. So yeah, I guess it is a question of not if, but rather when the Fed starts to make meaningful progress on cutting rates. And Lyondell Basel, not one we cover, but 11% div yield looks interesting. But for us, we prefer to focus on higher quality businesses in the industry, which we can get into now with my stock pick.
All right, let's get into that. Where are you seeing opportunity today?
AECI, it's a high quality chemical and explosives business. Historically, the company has been trading at a discount to its global peers, even though it competes with them directly. 2/3 of the business is offshore, but more importantly, the management team is realigning the business to its core strengths. So this involves divesting non-core assets and using that to deleverage the balance sheet and reinvest in the company's core operations. And the early results from the turnaround are promising. We saw that in the results a couple of weeks back, with EBITDA growing by about 22% and double-digit margins as well. So it's we believe that it's a combination of a focused and capable management team, and strategic asset disposals looks like it's going to work out for them.
All right, let's leave it there. Thanks so much for your time and sharing your insights of trade at midday, Jason. Now that was Jason Horn from Steyn Capital Management.